Good evening, everybody. Let's move toward getting this started. Paul, okay. So welcome everybody. I'm David Rosenblum. I know many, but not all of you. I'm the director of the International Tax Program, and this is the 25th Tillinghast Lecture. And I'm so happy to be back doing this. We had the last Tillinghast Lecture was in 2019, so we've had 3 years without a lecture, of course, because of COVID. And now we're back, I'm very happy that that's the case. And this is we're off and running again with plans for next year. I want to start by making one comment about the name of the lecture, the Tillinghast Lecture. I think many, but certainly not all of you, know that this lecture was named for David Tillinghast, who was one of the real great pioneers in international taxation in the United States. David was a loyal supporter of our program here at NYU, and just a terrific person from whom we all learned. I think our speaker will probably have something to say about David as well. We miss him. Our speaker tonight is also wonderful, and we've had some wonderful discussions already today. Our speaker is someone I've known for nearly 50 years, Paul Oosterhuis, who is a senior counsel at Skadden in Washington, D.C. He began his career working for the Joint Committee on Taxation in the Congress, which is where I met him when I was in the Treasury. And we've intersected for decades in the area of international taxation. I regard Paul as one of the absolute leading practitioners in this area, certainly in the United States, and more, it's fair to say, in the world. And so we're very happy and very lucky to have Paul here. He's going to talk to us about some very sophisticated foreign tax credit issues, and I'm looking forward to hearing a great deal about that. And so without any further wasting of your time with introductions, I'm going to turn the microphone over to Paul.
Thanks, David. Appreciate that. And it is true, we go back. I joined the Joint Committee staff in 1973 out of law school. It was the last time the Joint Committee ever hired somebody out of law school, so I think they realized they made a mistake when they hired me. And David was International Tax Counsel starting in 1977. We worked together, among other things, on the UK treaty back then that had the state reservation, or the reservation on California taxes and other issues in it. It was a great experience, and so I'm really honored to give the Tillinghast Lecture tonight. And, you know, David Tillinghast, when I was on the Joint Committee staff, was one of those practitioners who came in fairly often, sometimes with Bar Association folks, but other times with clients. And he was always one of those practitioners that was a model for those of us going into private practice, because not only could he make good arguments for his clients, he understood the government's perspective on things. And that's so hard for a lot of practitioners to appreciate, and so he could mold his arguments to fit what our policy frameworks were. He told me once that one of the best things you did as a practitioner in dealing with Congress and with Treasury is to tell your client what not to argue. And that is so true, that clients can instinctively make arguments that just don't resonate. And in fact, even Dan McCall here is shaking his head, that even turn the government the wrong way. And by being in the government, you learn, and David Tillinghast was one of those models that taught me that. So I am very delighted to be here tonight and to give this discussion. When I've thought for a while about what I wanted to talk about and knew what I wanted to talk about, but I didn't know what to label it or what title to give to the lecture. I really struggled with that. And for a while I thought that the title should be, What's Ahead if Pillar 1 is Dead? But I decided that was a little kind of catchy it reminds me, Dan McCall is here again, it reminds me of when Dan and I did a paper for University of Chicago, what was that, Dan, about 13 years ago, which is what's in order for assets crossing the border, and it was all about tax planning with 367. But so instead I decided to focus the lecture on foreign tax credits. And the other reason was I don't really think Pillar 1 is dead. It's on life support. When Notice 2023-55 came out, which was a notice in July that deferred the heart of the final foreign tax credit regs from applying beginning in 2022 until after the end of 2023, it seemed to me that gave us an opening to re-examine what taxes should be treated as income taxes from the perspective of what taxes we should allow as a foreign tax credit. And so I decided to structure my talk through the lens of what taxes should be treated as income taxes, because we now have time to think about that from a foreign tax credit point of view, and I do think we should think about it from the point of view of what taxes should we be imposing independent of our credit rules. But let's face it, to me, our foreign tax credit rules should reflect not just what our income tax is, but what we see as an acceptable income tax globally, because we can't, and we found this in the 2022 regs, we can't expect other countries to mimic our income tax, and they really shouldn't. We have all kinds of features in our income tax that are not worth copying. But so our view of what foreign taxes should be treated as income taxes should be formed by kind of an international consensus, a multilateral consensus of what taxes are reasonable, what forms of income tax are reasonable to impose. So I'm going to talk a little bit about what taxes I don't think should be income taxes. I'm also going to make a proposal for a new initiative for the inclusive framework, and if they're interested, for the United Nations, on the assumption that Pillar 1 is dead or dies, and on the assumption that digital services taxes and other similar taxes start appearing even more than they are now and continue to grow. And then I will finally reflect on what that means for our foreign tax credit regulations. And, you know, had lunch with David's students today, and we were talking about how the U.S. historically has cared about the foreign tax credit. A lot of other jurisdictions have a participation exemption, so they don't really care. But in a Pillar 2 world, they do care. It's just they're not asking what's a creditable foreign tax, they're asking what's a covered tax in Pillar 2, because the Pillar 2 terminology is if a covered tax is the tax that's taken into account in measuring whether you have a 15% rate. So with Pillar 2, most countries, if Pillar 2 is adopted by most countries as we expect, everybody's a foreign tax credit country in measuring your IIR and your UTPR under Pillar 2. So the questions that we're going to talk about tonight have application not just to the United States, but to other countries as well. So I'm going to start out with articulating a first principle that I believe we should consider in approaching these kinds of questions, and that is that I believe net income taxes are different from and should be distinguished from revenue taxes or gross income taxes. It's a pretty simple statement. It may be obvious, but it's often, I think, overlooked in thinking about what taxes we should treat as income taxes. To me, that principle is based on solid economics. I'm not an economist, but to me it is. And that's because the incidence of the tax is different. If you go back historically in the 1920s, and I went back and read Edward Seligman and T.S. Adams on some of these things, who were the two U.S. economists that were most involved in forming our net income tax in 1918, 1921, and throughout the 20s. They saw revenue taxes as largely being passed on to purchasers, and net income taxes as largely being borne by the owners of the capital or by the earners of the income. Today, that analysis has changed some and is more subtle, particularly with the net income tax. There's a large body of thinking, including in our Treasury Department and the Joint Committee staff, that the net income tax of corporations is borne partly by labor, but also more by earners of capital, or the owners of capital. Whereas if you look at their incidence analysis of revenue taxes like value-added taxes, it is assumed mostly to be borne by purchasers if the law allows price flexibility, and if, in the case of a new tax or a substantial increase, the central bank allows prices to rise. So to me, the incidence of a net income tax is much different than that of a revenue tax. And that should lead us to the following consequences. If we believe that we should have a credit for net income taxes, and I do believe we should, because that promotes neutrality between cross-border investment compared to domestic investment. I realize that others, I don't know if Dan Shaviro is here tonight, but there he is. Others disagree with that. And Michael Gratz gave a lecture here 23 years ago that to some extent disagreed with that. And I'm not here to get into that debate. I'm just starting with the premise that we are taking as a given that the neutrality principle is one that we want to maintain. And so if we do that, then giving a credit for net income taxes makes sense, but giving a credit for gross income taxes doesn't further that goal of maintaining neutrality because of the difference in incidence. And indeed, it could lead to windfalls for taxpayers. We talked about this with David's students earlier, that many of you will remember the bank cases in the United States and Brazil where they ended up getting a credit for a Brazilian withholding tax, even though the credit was passed on through gross-up provisions to the borrowers. So net income taxes make sense to be taken into account for credit purposes. Gross income taxes, not so much. Now, historically, there have been a lot of revenue-based taxes that are not income taxes, right? We have tariffs, we have excise taxes, we have sales taxes, we have value-added taxes. And today we have the new entrants in digital services taxes. And we're going through a process of trying to figure out which, if any, of those taxes should be treated as income taxes and which should not. And to me, I have a hard time grabbing a hold of all of that, given that we do have some gross revenue taxes that are treated as income taxes, most obviously withholding taxes on interest, dividends, rents, royalties, and to some extent today on services. But beyond these explicit revenue taxes, we have some what I call implicit revenue taxes built into income tax systems in many countries, largely through deduction disallowances and deduction limitations that I'll get into later in my lecture. So if I'm right that Pillar 1 doesn't succeed and that digital service taxes and other revenue taxes expand, which I think they will, then we have a problem that's going to grow in the future, and it's one I propose that we deal with. And I understand government's positions in a sense in liking revenue taxes because they're easy to administer, right? If somebody's making a payment, you know what the payment is, you take a certain percentage of it, and that goes to the government. On the other hand, there's a trap there for the government too, because if I'm right about incidence, that tax is much more likely to be passed on to the local purchasers or consumers of services than would be a net income tax. And so it may be that with more thought, some of these revenue-based taxes may be determined not to be in the interest of government, just as I don't think they should be creditable. I know with clients we have that have been facing digital services taxes, for example, their thought is that they will mostly get passed on to their customers. So to figure out what to do with revenue, how to deal with revenue-based taxes, I decided to first go through a little history on how we got to where we got, that we have some revenue-based taxes that are treated as income taxes and others that are not. Second, give a little data about the magnitude of these taxes today. Unfortunately, the data is a little bit out of date, but we'll go with what we have. Third, make the proposal that I mentioned before on what the inclusive framework and maybe the United Nations should pursue to try to deal with this issue, and then draw some conclusions for our foreign tax credit rules. I'm not going to talk about dividend withholding taxes. To me, dividend withholding taxes are different depending on your view of the intersection of shareholder taxes and corporate taxes. And so while there could be a nice discussion of whether dividend withholding taxes make sense, I'm carving that out tonight. I'm also carving out interest, and I do think somebody should address interest withholding taxes. But because debt is optional, not mandatory, you have a lot of flexibility as taxpayers for your capital structure, and you can put debt where you want to a great extent. Seems to me there are quite different issues with withholding taxes on interest than there are with withholding taxes on rents, royalties, and services. And so that's what I'm going to focus on tonight. I do think at some point somebody should think harder about withholding taxes on interest, but Michael Gratz and I used to say that the interest birds always flock to high-tax countries, just as the IP birds flock to low-tax countries, and that kind of flexibility you have in where you put your debt, to my mind, puts it into a separate category than some of these other items. Okay, so first, a little history. I went back to the post-World War I period when net income taxes really became discussed among different countries. And back then, while some countries didn't articulate them as source rules, they had what we call as source rules that really focused on rents, which were sourced where the property was located. That makes sense because rents relate to tangible property, and everybody knows where tangible property is located. Special rules for transportation property that could move, and there always have been special rules for those. But for property that was not transportation property, a source rule based on the location of the property seems intuitive and seems to make sense. For services, similarly, except for transportation and maybe communications, where again there were special rules, most of the services really were personal in the sense that they were conducted by people, and you knew where the people were. And so having the income be sourced where the people are made intuitive sense, really didn't generate a whole lot of controversy. You can go back to the 5 economists report in the early 20s or to Edward Seligman's writings, which I kind of enjoyed actually, and you'll see the intuitive sense of those. But for royalties, it's different because royalties don't have a physical presence. They have a legal presence, if any presence at all. Legal in the sense that where the property is used is where the property maybe is protected from by law or by contract. And so it didn't tie to having a permanent establishment or any kind of physical presence in the country. And I was really trying to find somebody who analyzed that and who said, nonetheless, we should treat royalties the same as we treat rents. And to be honest, I couldn't find it. Now, maybe somebody else can someday, but I couldn't find it. One of the main things I did, which was fascinating, is I went back to the 21 Revenue Act in the United States, which is where our source rules first came about. And the Senate version of that bill, T.S. Adams, who was the economist at the Treasury Department that Michael has written about, who really led the drafting, particularly on the international side of that bill. Believe it or not, he spent 18 days going over the bill, provision by provision, with the Senate Finance Committee members. And there's a transcript of those discussions. And I couldn't see any staff people asking questions or giving answers besides T.S. Adams. And it was fascinating. I really enjoyed reading through it. But every time he mentioned rents and non-resident taxation, he mentioned royalties in the same sentence. There were about 8 places in those 18 days where he talked about it, and they were always mentioned in the same sentence. So royalties I drew from that the royalties just tagged along with rents and really weren't separately considered. I must say, reading that hearing, this is an aside, but reading that hearing, gave me a new appreciation of sort of a textualist view of the law, because if the Senate Finance Committee is going to spend 18 days reviewing the specific language of the bill and asking specific questions about whether there's a semicolon or whatever, you can see a textualist analysis. But I compare that to the 2017 Act, where not only did the members not read the bill, they were actually in some places misled about what was in the bill. And that, to my mind, means a much different perspective, but I digress. So given the source rules for rents, royalties, and services as came out of the 1920s, the second step you have to think about historically is how were they taxed for non-residents. And this also was revealing to me in my old age. I hadn't really appreciated this, but in several countries, they had scheduler taxes before they had net income taxes, meaning just gross taxes on revenue, on certain types of revenue. So in the UK, in the middle of the 19th century, and in France in the late 19th century and carrying on through World War I, they had gross-based taxes on rents and royalties and not on services. They had whatever taxes they might have had, but they weren't gross-based taxes. As they developed a net income tax, primarily in France's case after World War I, in the UK before, then for residents, they folded those scheduler taxes into their overall net income calculation. So you got deductions, and if you still paid the scheduler tax, you could credit it against your net income tax. But for non-residents, they just stuck with the scheduler tax, which was a final withholding tax. In the United States, it was different, and I must confess, I hadn't ever appreciated this, because we didn't have scheduler taxes that predated our income tax, right? Pollock said taxes on rents and real property, even as part of an income tax, was not constitutional. We had our 16th Amendment that allows an income tax, and so then we designed a net income tax from the get-go. It wasn't building on these scheduler taxes that pre-existed. And as a result, while under the 21 Act, we imposed a tax on non-residents with US source income for rents, for example, and royalties. They could file a return and claim deductions against it, and if the 8% withholding tax that they had in that legislation was too much, they could get a refund. And that was true in the United States until 1936, when in the 1936 Act, they got rid of the ability for non-residents that didn't have a PE in the US to file on a net income basis for those taxes for that US source income, and enacted what is now the equivalent of our 30% Section 871 and 881 final withholding tax on revenues. And in reading the legislative history of the 36 Act, there wasn't a lot there, but they said, well, number one, it's going to raise revenue because some people are going to be paying gross, not net. And number two, it's going to be administratively more convenient because we don't have to audit those returns. So that's why they did it. Interestingly enough, I reached out to my tax partners in Germany and asked them about the German experience, and they said it was actually similar to ours, that for the German federal taxes, not the trade tax, for the German federal tax, up until 1934, they had a scheduler tax, but you could file a net tax return and claim a refund or a reduction in tax if that was appropriate. And that apparently in certain circumstances, even until the 1950s, you could do that in Germany. So it's not automatically so historically that just because you're taxing non-residents without a permanent establishment, that you have to do it through a gross-based tax. There were attempts in both the United States and Germany to say, no, you can file a net income tax. Today, obviously, though, most countries do have gross income taxes on rents and royalties and not have the option to file a net income tax. One of the things I learned in talking to David's students is that with respect to a couple of the taxes in India that I hadn't appreciated, you actually can go in and file a net return, but one of the folks said that people tend not to do it because it's a hassle. So keep that in mind for our foreign tax credit purposes. So going back to the 1920s, you have this regime that rents and royalties are subject to withholding tax and that services are not. You know, with rents, that maybe isn't such a problem because you have the physical presence. So in most countries, you could probably structure yourself to be subject to a net income tax and not have to pay the withholding tax, because it obviously could be very large given the expenses in running real estate. And in this country, we even gave an actual election going back to 1966 that even if you didn't have sufficient presence or plan yourself into having sufficient presence, you could elect to be treated on a net income tax basis. So, but with royalties, unlike rents, it's much harder to structure yourself to avoid the withholding tax if you need the IP in the country. The main thing taxpayers try to do is avoid having the IP in the country. And this is one of the things that is peculiar about the whole history of royalty withholding taxes. Because most of the time, if you have royalties going into the country, it's because you're doing some manufacturing or other activity that you would think the country would like you doing there. And so why would countries impose a withholding tax on royalties where in circumstances where if you sold goods into that country, you would have no tax, but if you manufactured in that country and paid a royalty out, you would have a royalty withholding tax. But that's the way our system has been. It brings to mind a vignette from the 2017 Act with respect to BEAT. This is quite different in a sense, but not really, because when BEAT was first proposed, the foreign auto companies were deadly set against it. And they had the senators from their state, Senator Portman and Senator Toomey, all up in arms about it. But then they figured out that their royalties were in their cost of goods sold. And so they weren't subject to BEAT. And then they were okay with it. But the argument, had those royalties been subject to BEAT, is that just means that, you know, Toyota and Honda is going to have to manufacture in Japan and sell into the United States because the BEAT would disallow their royalty deductions, which is kind of like imposing a withholding tax. And once they found out that that wasn't going to happen, which the Joint Committee didn't fully appreciate at the time, but that's another story, that led them to back off, and that's one of the main reasons that the BEAT got enacted instead of some alternatives that were being considered. So royalty withholding taxes, to the extent they apply, are a problem to me. Now, granted, a lot of treaties with developed countries reduce or get rid of them, but they do apply in a fairly broad range of circumstances. And my thesis is that the withholding rates haven't kept pace with the reduction in income tax rates. As income tax rates have come down from the mid-40s 20 years ago, 30 years ago, to the mid-20s, which is the OECD average now, withholding tax rates, I believe, haven't kept up with that. Certainly that's true in the United States, where we still have our 30% withholding tax rate, even though our corporate tax rate, which was 48% when I started practice, is now 21%. And I was looking for a source that would give me an easy table to show in, like 10 different countries, withholding tax rates 30 years ago, 10 years ago, so forth, and income tax rates. And there's no ready source for that we could find. It was really pretty frustrating. But fortunately, in 2022, the OECD did a survey of its members and the Inclusive Framework members on what their statutory withholding rates were, and they published a survey by type of income. And for royalties, out of the 112 countries that they serviced, they found that only 18 of them did not have a withholding tax on royalties, and most of those countries were what the OECD calls investment hubs, which is their euphemism for tax-advantaged countries, like the Netherlands, for example. But the other 96 do, or 94 do, and the average rate is between 15–16%. If you did an interquartile range, it would be between 10 and 30%. There's a few that are as low as 5, and Argentina, for example, is 35. But most of them are in that 10 to 30% range. And I would submit that unlike in the 1920s, that's a range of withholding tax that can't be seen as approximating what an income tax would be. if you're subject to the full statutory withholding tax. I mean, when you think about it, if the average income tax rate is 25% and a 15% withholding tax is imposed on it, that means you'd have to have a 60% operating margin or a 60% profit level, 60% of your revenues, in order for the 15% withholding tax to be the equivalent of a 25% net income tax. And very, very few taxpayers have margins that are as high as 60%, maybe a couple do, but not very many. So at the rates that today we have withholding taxes on royalties, we are overtaxing cross-border royalties, which could well be a disadvantage to the governments who are opposing that tax, but are also, given that the United States is crediting them in many circumstances, is allowing us to take the consequence of that, if you will, over-taxation. But how large is the impact of that? So I went to the statistics of income data the IRS publishes every year. They do a survey of the Form 1118, which is our foreign tax credit form, and they have really nice tables now since the 17 Act that show the amount of income in each basket broken down by categories, each foreign tax credit basket broken down by categories, and the amount of taxes. And it's interesting because it shows for 2019, the most recent year, that there's about 170 billion of royalty income for corporate recipients in the general basket, and only about 7 billion of taxes that were claimed as credits against that income. So that's a significant number. It's not a huge number, but it is a significant number. What it tells you is that a lot of companies are constructing their activities to try to minimize that tax, but nonetheless, 7 billion is not a small number. The other thing is I'm a little suspicious of the data because they have an other income category that is foreign source income, but not in royalties, and that's about 35 billion, and it has 5 billion of creditable taxes associated with it. So I kind of think some of that may be services income, but a lot of it could also be royalty income, and taxpayers just weren't careful because it's not in the branch basket. This is all general basket income. It's not Subpart F income. It's not GILTI income. It's 901 credits in the general basket, and there aren't that many other categories of income that go in the general basket where you, as opposed to the branch basket. So even if it's not a huge problem for the economy, it's a material problem at $7 billion a year. And for our software companies, it's clearly a big problem. Those of you in government and many of you in private practice have seen what happened with the 2022 final regulations that narrowed the definition of what royalties were properly sourced in a way to allow foreign taxes to be creditable. And our software companies understandably push back very hard on that source rule because they do pay a lot of withholding tax. And so for that industry, which they say is about 10% of the economy, I don't have independent verification of that, the regs really cause them a problem. And so I think it's fair to say that, the withholding taxes on royalties are a modest but significant problem generally, and particularly a problem on the software industry, which is going to grow. So let's put that aside now and focus on services. Services didn't have withholding taxes to speak of back in the 1920s because the services were personal and they could be taxed where the people were located, and that makes sense. It's not clear to me historically, I just haven't taken the time and the resources to get into it in more detail, when these taxes started appearing. I believe in India in the 1960s, the students from India said they were comfortable with my saying that India started having non-resident services taxes in the 1960s. By the time of our foreign tax credit regs that were published starting in David's days in 1980, if I remember right, and were finalized in 1983, there were sufficient of those taxes that we actually had examples in the 901 and 903 regs of those taxes, and they were declared creditable under 903 if your tax base included taxing non-resident services under 901, which was permissive. So today, with the 83 regs still applying, given the notice that delays the 2022 regs, a non-resident services withholding tax imposed by a foreign country can be credited in the United States. And of course, we agreed that India could have imposed it in 1989 in the treaty that we signed with them that year. So we've recognized these taxes for a while. And because of the differences between royalties and services, particularly technical services, there's been a lot of grappling with the fundamentally different consequences of having a services payment versus having a royalty payment, one subject to withholding tax, the other not. And that has really moved a number of countries in the direction of imposing a withholding tax on what they call technical services. And that was, in effect, codified by the UN in their model treaty in 2017 after about 5 years of discussions on how to define technical services and whether it should be something on which withholding taxes could apply. Because let's face it, the lines between royalties and services, particularly when you're talking about something that could be described as technical, is a difficult one. So we've had, over the past 20 years, the surfacing and some expanding of withholding taxes on services. And when you look at just the pure numbers, it surprised me at least as to how many countries impose them. Two data sources for that. One, the OECD survey that I mentioned from 2022, itemized withholding taxes on non-resident services as either managerial services or technical services. And out of the 112 countries, half of those that are OECD members, so half of the 38, and then 2/3 of the rest had some form of withholding tax that was imposed on non-residents in either technical services or management services or both. But most of them had a definition of technical services that included management services, so they had both. I was a little suspicious of that data, if for no other reason than they said the US had one, and of course, technically we do, right? Services can be subject to 871 and 881, but as a practical matter, they don't apply. So I'm not quite sure how the source rule computations were done for purposes of the OECD survey. But to the rescue came our friends at Baker & McKenzie, who are representing the software companies that were trying to persuade the government on the 2022 regs. They did a 120 country survey and assure me at least that they filtered those that don't source non-resident services to their country. And they found that out of the 120 countries that they surveyed, 72 of them imposed some form of services withholding tax on non-resident services that are performed abroad but are still sourced in their country. The impact on U.S. taxpayers here is fairly modest. Again, going back to the to the statistics of income data, U.S. corporate taxpayers in 2019, according to the 1118 forms, claimed about $3 billion of credits for services, foreign taxes paid on services. Again, that data is kind of confusing because we're talking about services performed in the U.S. and paid for abroad. And so you would have thought that $3 billion of tax would be matched with very little income, but there was some income there. And so I'm not quite sure what's going on in that data. And again, this is not branches, because that's in the branch basket. And this is not financial services, because most of those are going to be in the branch basket as well. So it's a little bit puzzling, but there are $3 billion in 2019 of credits. You add to that the $7 billion of royalties and the $5 billion of other income, which could well be a mix of these largely. And now you're up to about $15 billion a year of foreign tax credits. I suspect most of them are actually taxpayers are able to use them, and they're not expiring unused. If you were just to decide we're going to repeal the ability of taxpayers to take those taxes as credits, That would raise $15 billion a year. Over 10 years, that would be more than what BEAT was scheduled to raise, because it would be between 150 and 200 billion over 10 years, depending on how you factor in growth. So to me, the issue of allowing these taxes to be creditable is a big enough one that it's something we should think seriously about. Now, the taxes on services that I'm talking about, the $3 billion, those are not DSTs, because there were very few DSTs that were in effect in 2019. And since then, of course, we've been struggling with whether they're eligible for the credit or not. So the data for later years, when it comes, it's not going to be clear how much of the DSTs would be included in those numbers or not. And of course, none of this data deals with foreign taxes that are paid by CFCs and come back through tested income, or come back through, say, foreign-based company services income, because that's in a different basket or a different category in the SOI data. And so we can't tell. And many of the digital services taxes, you have to admit, are not eligible for the credit today, particularly with the caveats that were left in place in Notice 2023-55. Some are, though. And one example is the Indian equalization tax, which is specifically structured as a non-resident withholding tax. Apparently, you can come in and file a net income tax return for that tax. It's a 2% tax, so it's not huge. But that tax is creditable, notwithstanding the provisions that stay in effect after the notice. So again, as with royalty withholding taxes, I would submit that the services withholding taxes overtax the relevant income on a net income basis. And this is particularly true with things like management services, because a lot of them, are charged out at a cost plus 10 basis, something like that. And so if you have services, management services that you're providing to an affiliate, you have 100 of costs, you're marking it up by 10%, you're charging 110, and there's even a 10% withholding tax, that's 11, that totally wipes out the profit. So for a lot of these services, these withholding taxes clearly lead to overtaxation, but for our foreign tax credit, if it's allowed, would be a real problem for the countries, and I would say a problem for some of the governments, because they could discourage activities that they don't necessarily want to discourage. Now, I understand the interest of foreign governments in imposing some of these withholding taxes on services. First of all, as I said before, the difference between technical services and royalties is tough to differentiate. And so having substantial tax consequences apply based on that difference doesn't make sense. And in today's world of the internet and remote services, it's even harder, I think, to justify a difference between royalties and the treatment of royalties and the treatment of services. I like to give the example in the consumer world today of, if at least under our rules, if you get movies on your device and you download them on your device and you can keep them there for a period of time, then you're paying a rent or a royalty, which is subject to withholding tax. But if you have to access on the cloud, then you're getting a service, and that's not subject to withholding tax. And so those differences are nice distinctions for lawyers, but I think for tax systems, they don't make a lot of sense. And doing something that tries to integrate the treatment of services and the treatment of royalties is a project that I think we should undertake. These withholding taxes, to me, are a problem for the U.S. government because we're giving a lot of credits. They're obviously a problem for software companies if they don't get the credits, at least. And I think with Pillar 2, they're going to come to be a problem in other countries as well. But these taxes on revenues go beyond explicit taxes like withholding taxes. They also apply to some implicit, what I call implicit taxes that are effectuated by disallowing deductions and putting limitations on deductions. I'll expand that in a little bit. But an example of that, and in some countries, there seems to be a coordination between the deduction disallowances and the withholding taxes. When we were hired by clients after the final 2022 regs to look at some of these disallowance provisions in various countries, what we found is that many of them apply to operating expenses, and they apply both to unrelated party and related party expenses. And so I don't think of that as being base erosion. I think of that as just being deductions for costs. Now, I know Tricia Brown's here. She and I have talked about that, and some folks think unrelated party expenses can be base eroding, but that's not my definition of base erosion. My definition of base erosion is that it's somebody manipulating, and with third-party transactions, it's hard to see the manipulation. But so there's a number of countries that do disallow royalty deductions, for example, or services payments that are cross-border, or put caps on them. My favorite one to give as an example is in Argentina. They have a 35% corporate rate, a 35% withholding rate. For some reason, for trademark royalties, the withholding tax is only 28%, but they also disallow 20% of the deduction for trademark royalties, so that you get a synchronization, but it's done partly through a deduction disallowance and partly through a withholding tax. So my point here is, if we're going to make progress in trying to get rid of some of these withholding taxes, we can't not ignore the fact that deduction disallowances can achieve the same result, and maybe we need to do something in that direction as well. So what do we do about all of this if we think, as I do, that something should be addressed here? That leads me to my second principle for our foreign tax credit perspective, which is, if countries are applying net income taxes, which I believe they should, then we should be fairly flexible on how they allocate income between them, particularly if they're doing it by a treaty or by a multilateral instrument where they decide how to divide it up, even if that's different than what we would do. Because I don't know why we should care if, for example, the EU adopts a rule apportioning income among them that is different than what we see income as being allocated to the different countries. The rates are not that disparate. Sure, Ireland's 15 and France is 30, but we should respect that and allow those taxes to be creditable, particularly if they don't have overlapping taxation, if they're not grabbing each other's tax base. So my second principle is that we should be flexible on the allocation and measurement of net income once we insist on having taxes on net income and not on gross income. And here is where I think the inclusive framework and maybe the UN can be helpful. It is to take on an initiative that would say, we don't think withholding taxes on rents, royalties, and services should apply unless they give an option to file a net income tax return. That is really modeled after the UN Article 12B, which they adopted in 2020, if I remember right, and applied to to non-resident digital services taxes. But they do give an option to file on a net income tax basis. So it's kind of like our provision for real estate, but it would be applied more broadly to technical services, maybe to other types of services, and to royalties as well as to rents. The goal would be to establish an international consensus on how you determine that net income, and that you would only give a credit for a foreign withholding tax if it gives a net income tax election, and then only to the extent of the lesser of the withholding tax or the net income, like our voluntary payment rules are today. Similarly, in this effort, digital services taxes would be folded into it, so that digital services taxes could be adopted, but they'd have to be adopted in this format, kind of like the Indian equalization tax, that basically changes the game from being a tax on revenues to being an allocation of taxing base to the payor's taxing jurisdiction. Now, so Article 12B is my model here. Now, of course, Article 12B in the UN Model Treaty doesn't say that you use arm's length pricing to determine the net income that's going to be subject to tax as an alternative to the withholding tax. Rather, they use a formulary approach. And, that's not surprising given many of the participants in the UN that have a distaste for arm's length pricing and like formulary apportionment. But one of the things I think we learned from Pillar 1 is that the inclusive framework doesn't like arm's length pricing either. I testified in a consultation back, I think it was 2019, on how they could tweak transfer pricing to accomplish their destination-based taxation goals, allocating more taxing jurisdictions to the market, something that a bunch of us wrote about in the book with Mike Devereaux and 4 others that actually didn't come out till 2021, but our writing took place a few years before that. And I thought the way to do that was by tweaking the ground rules for transfer pricing, but basically sticking with that format. And it was clear in that hearing that I was an outlier. I mean, the other taxpayers that were testifying and other governments that were testifying were talking about going to formulas. Formulas for amount A, formulas for amount B. They're all now formulaic and not, granted amount B is trying to mimic transfer pricing, but it's still a formula. So from that, what I have learned is 2 things. First, neither governments nor business want to build these things around arm's length pricing. They want to come up with formulas. And second, that actually there's a realistic possibility after some substantial discussion of achieving 1 or more formulas that could actually work to apply in a broad range of jurisdictions. So for that, I would suggest we try to encourage the inclusive framework to get to work on starting to discuss how we come up with ways of allocating net income from non-resident services and royalties and to a certain extent rents if it needs it, to the payor jurisdiction and have that be a constraint on these gross income taxes. One final point, I realize I'm running over a little bit here, is why is this in the U.S. interest? We have a favorable balance of trade on services, and that those services numbers include royalties and rents. But I think given the amount of foreign tax credits that we give today, I can add it up to be maybe, as I said before, maybe as much as 15 billion, that there's something there for us to play with in terms of coming up with a package of proposals that would include a 12B type proposal generally applicable on a reciprocal basis. We're not going to do it through multilateral instrument. We're not going to do it through our bilateral tax treaties because that process isn't working very well. But the Taiwan legislation that has now been proposed by the Senate Finance Committee and the Ways and Means Committee is an interesting example of how you can do things by reciprocal legislation. And so I would suggest we would think about that here, of basically having a provision that while in our treaties we might still want to have residence-based taxation of services and royalties, but nonetheless, with other countries that we don't have a treaty with, we could elect to have the 12B type regime if they do it, if the other country does it on a reciprocal basis. And if we were to do that, I think from a scoring perspective, we wouldn't lose a significant amount of revenue. Now, I think if we're going to do that, there's a couple of things we need to do with our foreign tax credit rules, too, that probably require legislation. First of all, in Section 903, we would need to end the creditability of services, royalty, and rental withholding taxes unless they adopt the net income format. And then in 901, I would also suggest, while we're doing this legislation, that we add the ability to take a rifle shot approach, what I call, to disallowing foreign tax credits. One of the problems with the 2022 reg project process was the view that you had to make an income tax creditable as a whole. And so you had to make kind of an overall judgment. And that drove Treasury and the IRS crazy, and that's why they came up with these rules that said you've got to mimic our system. But the law doesn't have to be that way. The law could be the way that you can just disallow specific foreign taxes that are paid with respect to specific aspects of a foreign tax system that aren't internationally appropriate. And so we could, for example, say to Argentina that disallows 20% of trademark royalty deductions, measure the tax in your country with and without that disallowed deduction, and we'll disallow the piece of your credit that relates to the disallowed deduction. I think if we were going to go this route of trying to get rid of withholding taxes, we'd have to think about something like that, because there really are enough situations where countries coordinate their withholding taxes with their deduction disallowance provisions. And so we would need to do that. And that probably is best done by legislation as well. So I have a three-part proposal for the United States and for the inclusive framework. One is to pursue getting rid of these withholding taxes, replacing them, turning them into sticks to get taxpayers to file net income tax returns. And then in the United States to amend our 903 statute and our 901 statute to back that system up. And it seems to me that would be a process that could achieve a clear improvement of our income tax system by avoiding having credits for revenue taxes and minimizing the expansion of revenue taxes. I do admit that getting these formulas for what the net income amount is going to be will take some time. I'm also glad to say that I'll probably be retired by the time that happens. So, thank you.
Okay, so that was a lot to think about and a fairly short presentation. So I'm going to open the questions. If there's anybody who wants to raise any questions about what Paul has talked about or anything else about the credit, we can take a few questions before we break for a brief reception. Anyone want to raise their hand? Yes. Yeah.
So you had mentioned that to get rid of the withholding tax system, to kind of use that as a stick to get foreign taxpayers to file returns in the US to get the benefit of the net income tax.
Right.
But for example, there are several treaties that kind of exempt royalty income from being taxed in the jurisdiction and allocate taxing rights completely to one of the contracting states. An example in this sense would be the Irish treaties, where royalties for the use of aircraft, the taxing rights are allocated entirely to Ireland. And essentially, for example, in a US-Ireland tax treaty, or if I'm from India, the India-Ireland tax treaty, the entire taxing right would be with Ireland.
Right.
Essentially, there would be no tax in the jurisdiction where the aircraft or the asset is used.
Yeah.
In that case, and a lot of these lessors, they create special purpose vehicles for investments into various countries. These aircraft lessors may have separate SPVs for each aircraft, for each asset as well. So filing an income tax return in such cases in a foreign jurisdiction often carries a very high administrative cost, which these companies would at all costs like to avoid. So how do you kind of tackle that issue?
Sure. Yeah. It's a good question. I'll repeat the question, because I'm not sure everybody could hear, but there's a lot of situations, and he was giving the example of aircraft rentals, where they allocate the taxing jurisdiction to the residence jurisdiction because of and what would be the difficulty of getting net income calculations in the use jurisdiction, if you will. Let me say a couple of things. I don't mean to be saying that, for example, between the U.S. and Ireland, which is an example you used, but where we have a zero withholding rates on royalties and the residence country taxes at all, that's still fine, because you're still taxing net income in one jurisdiction or the other. I don't mean to be saying that should go away. What I do mean to be saying is that the withholding tax, if the source country is going to be taxing, they should be taxing it on a net income basis, and the withholding tax should just be, and it should be agreed with the two countries, and the withholding tax should just be a stick to get you to file the net income tax return. And it's true that net income tax returns are administratively difficult and difficult for countries. But I said this at lunch, and I think David understands this too, and those of you who do work or did work in the government. You know, I always found taxpayers used administrative difficulties as an argument when they didn't have anything better to argue. And when there's something good for them, like FDII, for example, they'll put up with all kinds of rules that give them administrative difficulties. It's just when the tax is going up that they don't like it. So I'm kind of sinister about that, and particularly in today's world, with information flows, I just don't think the administrative issues of filing a net income tax return for a non-resident, if you have reasonably clear ground rules about how you file it and what income is allocable, I just don't think that should be an overriding concern. It might well have been in the 1920s and the 1930s, but now I would say that's not so much a concern. Yes?
So, in the net, so you said about filing of net income taxes. Now, when we talk about net income, we have two aspects to kind of allocate. One is income itself, and then the expense. So, when we are going to allocate expenses country by country, actually find net income, how would, I mean, from the perspective of every country, trying to see whether that expense is actually for that source of income, would that be an issue or?
Sure. Yeah, if I understand the question, it's because you're allocating expenses to net income, don't you have difficulties there? I mean, one of the interesting things about Amount A in Pillar 1 and also 12B is that they both start with financial statement income, which is a net income number. And so I'm fine with whacking that up as countries want to do. And I really think that's the direction we're going in, because that's the only common tax base that we could ever agree on is financial statement income. We're not going to otherwise agree on a common tax base. And so if the formulas that are used, I mean, when we think about it, the 12B formula and the Amount A formula have a lot in common, right? The 12B formula says take your business segment revenues and your business segment operating profits, and take that percentage, apply it to local revenues, and that's your profit from the relevant transactions, and then split it 70-30, 70 to the service provider jurisdiction and 30 to the service recipient jurisdiction, whereas Amount A says take that same measurement, operating profit over revenues, and if it exceeds 10%, then allocate 25% of it to the recipient jurisdiction. So there's not that much difference in those formulas. Those formulas don't work when you're dealing with internal pricing, right? Because they deal with revenues that are consistent between financial statements and tax. And so you'd have to come up with new formulas to deal with other situations. But at least in those formulas, you're starting with a net income number, and you don't have to worry about allocation of expenses. Michael?
Yeah, so let's just understand your formula. Suppose the foreign withholding rate on a payment to the U.S. is 10%. Under your system, you can't just accept the 10%. You got to file this return
Right.
to see if the net result is lower, or else you won't give any foreign tax credit?
Yeah. Yeah. I mean, that's our voluntary payment rule, right? And so, yeah, and you know, I understand that in India, for example, some folks could file a net income tax return but don't on some of their non-resident taxes because they don't want to get into arguments with the Indian government. But you know, people from the IRS should be aware of that and take that into account, because why should we be giving a credit for more taxes than what you're legally obligated to pay?
Let me try one.
Sure.
I agree with you that taxpayers rely on administrative difficulties only when it's a situation where that's their argument against a higher tax. But one of the aspects of seeking net income returns of reporting net income, is I think that you'd be asking the country that's giving the credit to audit not just a net income return, but a return that's based on expenses incurred abroad. And I think that might put unusual burdens, not on the taxpayer, but on the government. Because if you're talking about the net income from a royalty, I mean, by definition, I think most of the expenses are going to be expenses incurred outside the United States. That's going to be an unusual problem for the tax administration, I think.
Yeah, no, and that's the challenge in coming up with some of these formulas. But we do have country-by-country data now, right? And it's not very good. Hopefully it'll get better over the next few years. And that gives you something to work with in terms of what's going on in the country that's the counterparty to your transactions. I mean, look, I'm not saying it's a slam dunk to come up with a formulaic way of doing this, but it seems to me it's worth giving it a try. Most of the problems I think that we have in the international allocation of income are in the realm of services and royalties, more so than transfer prices for goods. And so if we can make progress in solving some of those problems in allocating taxing jurisdictions and not lead to the continued expansion of these revenue-based taxes, which to me is like, fingernail on a chalkboard, you can make some real progress.
Yeah, I would agree with a lot of that. In fact, you raised an awful lot of independently valid points in your presentation, which, by the way, was terrific. Let me take one more question from the field before from the audience before we break for a reception. Anybody else want to raise anything? Yes, Valentin.
I was really fascinated by the lecture, but what would interest me, you mentioned the interaction with Pillar 2 several times. So first of all, do you think that under the current setting, let's assume Pillar 2 will not be implemented by the US, should QDMTT be credited against the US tax base, or at least guilty? And the second issue, why do you think that royalty withholding taxes is an issue within the system of Pillar 2? Because basically the royalty withholding tax will be assigned to the CE owner, so it basically raises the effective tax rate. Royalty deduction is allowed under the GLOBE rules as well, so where is the issue with Pillar 2?
Yeah, no, well, but the issue with Pillar 2 is the same as it is here, is if royalties through withholding taxes are being overtaxed, and you have situations where that tax is actually being passed on, then you shouldn't be treating as part of the tax that's being paid by the earner of the royalty income for Pillar 2 purposes any more than you should be giving a credit in the United States. So I mean, some people would say, well, for Pillar 2 it's not as important because you have a country by country. I would argue that it may be even more important because you have a country by country, and these withholding taxes can distort the tax levels in different countries, and so seems to me, and the Pillar 2 definition of a covered tax pretty much tracks our broader concepts of what is an income tax, but it clearly allows these withholding taxes to be covered taxes, right? And yes, I do think QDMTT should be credited in the United States.
Okay, well, I think there's a lot more to ask and to be discussed about this subject. I think we'll break up now and have a reception. There's food in the back of the room. Thank you all very much for coming, and thank you to Paul for a fabulous lecture.